There's no resolution apart from the completion of the bonfire. In essence, so your house is already. Funnily enough, I've used this analogy. The house is already irredeemably on fire. In other words, the petrol is alight. You don't put it out. The house is on fire. Funnily enough, as I like to say, in terms of gold and silver, and I understand there's a lot of precious metal fans out there, you can still get insurance for the house by buying, obviously, the precious metal. The price is going up, but actually, normally, if your house is already on fire, beyond redemption, in other words, it's in the beams, it's in the roof, it's everything, you normally will not be insured, but you can still buy insurance. And in fact, you could buy 5 or 20% insurance, or as I like to say, how about 150, 250% and get a better house afterwards? So, this is not the time for traditional financial advice of timid allocations to a real true reserve asset, whilst in a debt debasement crisis, which is the death of the phony reserve asset that was provided as one for 40 years on the bull market that ended the late stages of 2020, which is one of our most seminal calls in terms of, listen, this is going to be truly, truly significant. So the ability to originate new debt instruments by banks and their willingness is retreating immensely because A, they can't sell it on, which is securitization, and B, that means they have to sit with the risk on their books, and the outlook for debt, the outlook for employment, and the outlook for a lot of things are not looking that rosy. We just had.
Market analyst Francis Hunt has spent decades perfecting his Hunt volatility method, and what he's seeing now has him more convinced than ever that we're entering what he calls hyper-stagflation, an economic environment triggering the most explosive precious metals rally in history. While silver struggles around $38, Hunt is tracking patterns suggesting we're about to enter unobtainium territory, where physical silver becomes virtually impossible to obtain. Here's the number that should stun every investor. Hunt's technical analysis points to a $597 silver target based on projections from current lows to anticipated highs. This isn't modest gains or traditional moves. We're looking at silver's first proper bull market since 1980, where 2011's spike was merely the opening act of a 5-wave structure building for over a decade. But Hunt isn't just making bold predictions. He's documenting complete financial system breakdown, a house already irredeemably on fire, where bonds have collapsed 55%, yet investors can still buy insurance through precious metals at generational discounts. Before we reveal Hunt's technical breakdown of why silver is headed for triple digits and the economic collapse scenario making it inevitable, smash that subscribe button for exclusive analysis. Thank you.
I thought it would be appropriate to start with your overall view of the world in terms of this acute and synchronized global sovereign debt crisis that we're facing. In your interview with Maggie, you used words like collapse, the end, and irreversible. So I wanted to ask if you could get us a current update on that view and whether anything's changed in the past 2 months.
The Joy Division tune stays the same, I'm afraid, Trey. We're still jamming, and we're finding that the notes are still ringing true as we continue to walk towards exactly what we expect. In fact, I'll be referencing the British debt market has almost bullied its way to the front of the queue, wanting to be the biggest idiot in terms of their rates, and how we think it's almost very short-term imminent. I would argue that we have some form of rate-based spike and crisis, which is going to cause contagion in their property markets. We've already seen the US markets get very, very heavy with inventory waiting to sell in there. We've seen since speaking to Maggie, which was a very popular episode. So thank you to everybody who enjoyed that. Don't forget to hit like and subscribe and do it again and comment. We're very glad to have had that discussion. And since then, timber, or lumber, I should say, has done the timber fall as well to an extreme rate, which points to new building and permits going on the real go slow. It's very sensitive, obviously, to the US housing market. So there's a lot moving forward. The debt markets are very precarious. I'm going to highlight UK as being especially bad now, and I think that's going to be your next headline in terms of rates and debts. and that Labour government, which is pretty socialist and are unearthing black holes faster than anyone with a telescope could ever manage. So we're just seeing ongoing compliance and further confirmation of our base case model being box ticked and progress since that interview.
Terrific. So can you talk a little bit about sort of the size of the sovereign debt load and how you think it will be resolved?
There's no resolution apart from the completion of the bonfire. In essence. So it's all, your house is already, funnily enough, I've used this analogy. The house is already irredeemably on fire. In other words, the petrol is alight. You don't put it out. The house is on fire. Funnily enough, as I like to say, in terms of gold and silver, and I understand there's a lot of precious metal fans out there, you can still get insurance for the house by buying, obviously, the precious metal. The price is going up. But actually, normally, if your house is already on fire, beyond redemption, in other words, it's in the beams, it's in the roof, it's everything, you normally will not be insured. But you can still buy insurance. And in fact, you could buy 5 or 20% insurance, or as I like to say, how about 150, 250% and get a better house afterwards. So, this is not the time for traditional financial advice of timid allocations to a real true reserve asset, whilst in a debt debasement crisis, which is the death of the phony reserve asset that was provided as one for 40 years on the bull market that ended the late stages of 2020, which is one of our most seminal calls in terms of, listen, this is going to be truly, truly significant. So the ability to originate new debt instruments by banks and their willingness is retreating immensely because A, they can't sell it on, which is securitization, and B, that means they have to sit with the risk on their books, and the outlook for debt, the outlook for employment, and the outlook for a lot of things are not looking that rosy. We just had, as well as a little additional point in this, we've just had a further revision on the last 2 years of payroll numbers. So we like to talk about lies, damn lies, and statistics. And we've spoken of the fake number day when non-farm payrolls comes around. So this is the third haircut. Normally you get a number, the market reacts. A month or two later, you get your first revision, almost invariably downside. By the way, those have averaged 58,000. But more recently, June was revised 133,000 down and May 125,000 down. And then at the year end, you came for a second haircut. Last year, they actually said 918,000 jobs weren't truly created. This is a function of the birth-death model and a lot of other things. And believe it or not, there's a tweet that's come out today, and I believe I'm sharing screens. This I've just seen, by the way, and this is why I'm bringing you to this point. It's kind of breaking news, I suppose. The BLS is set to revise down U.S. job numbers by a further 550 to 950 for the 12 months ending March 2025, which was already included in that previous annualized downside revision. So now we've got to keep track of the monthly revisions to the downside after the initial release, which is normally a month or two later, the annual revision, and now we're getting an extra normal revision, and the biggest 12-month downward revision in 15 years. So the other point I want to make about this trade that's super important before handing back to you is that we stated when you met the criteria of a recession, the US was in recession. And they just stamped out the meaning of the word recession entirely, redefined it and said, you can't be in a recession with this red hot labor market. And we said, A, it's not a red hot labor market. B, you don't get to retrospectively change definitions. In short, it's my suspicion that the US has been in and out of recession since that first recessionary experience, which I think takes us all the way back to 22 under Yellen and the Biden regime. So in terms of everything that's coming out now, lies, damn lies, and statistics, and maybe a bit of propaganda thrown in there. Don't believe what you're seeing. Your intuition about what's truly going on, and I'll leave one final anecdote before handing back, is inflation is running exceptionally hot. A lady did a Walmart checkout current day basket on a till slip she had from 2020. And that inflation showed 134% in 5 years. So a 2020 on a like-for-like basket online checkout was costing 2.34 times more over 5 years. I know the citizen feels what I'm saying and is not buying the statistics.
Francis Hunt earned his market sniper reputation through his autonomous Hunt volatility method, identifying compression in trading patterns to predict explosive breakouts. Unlike conventional analysts focusing on price movements, Hunt's methodology centers on volatility patterns, revealing when major moves build beneath the surface. Hunt's current silver analysis identifies a volatility constriction funnel, where markets squeeze into narrow ranges before explosive breakouts. His charts show silver has triggered initial phases with 3 distinct impulses pointing toward inevitable breakout territory. Real inflation is shocking. Hunt cites a Walmart basket from 2020 now costing 2.34 times more, 134% inflation over 5 years, not modest government rates. The citizen feels what I'm saying and isn't buying the statistics, Hunt emphasizes. This manipulation creates alternative reality while the system collapses. We are in hyper-stagflation, an accelerated extreme version of stagflation, he explains, where stagnation is higher, inflation is higher, and cost of living increases while employment disappears. With $37 trillion in debt and exponentially increasing borrowing, the debasement process has just begun. Hunt's gold analysis reveals systematic manipulation. Despite reaching new highs, gold has been capped at nearly identical monthly closes of $3,288, $3,289, $3,290, and $3,333 for 4 consecutive months. You've been knocked back to $3,300 or within $12 of that each month for April, May, June, July, Hunt documents. This suggests powerful forces containing precious metals prices temporarily. But control is breaking down. Increasing debt amounts are being pushed onto shorter maturities while rollover cycles accelerate. Gold must stand up first before silver's explosive phase. He's the king of anti-fiats. There is no other anti-dollar trade than handing back fiat and taking monetary metals, Hunt states. Hunt's supply analysis reveals dynamics few understand. Drawing parallels to platinum's shortage, where London has less than 0.3 million ounces available, Hunt believes silver approaches unobtainium status, virtually impossible to obtain at reasonable prices. The fundamental driver involves underestimated technological demand. Solid-state batteries would take 96% of mine annual supply, with just 20% market penetration, Hunt calculates. This creates perfect storm conditions. Traditional paper manipulation becomes impossible when physical supply disappears. When shortages hit and it becomes close to unobtainium, you've got shortages, he warns. Hunt's technical analysis shows silver has broken out of a volatility constriction funnel, indicating initial stages are underway, even though prices haven't reflected supply reality. Hunt's quarterly charts reveal patterns spanning back to 1980 highs, showing a massive cup and handle formation building over a decade. Silver recently traded at quarterly highs matching both 1980 and 2011 peaks when adjusted for current conditions. We've actually been at a quarterly high point if we closed, Hunt notes. However, his analysis suggests potential pullback before the final explosive phase. You could have that little pullback. It won't go anywhere near as deep, but it'll consume time and come back up. The key level is $50 silver, final resistance before open territory begins. That'll be the 3rd time, the 4th time a lady we break. Once we threw $50 that 4th time passed, that is just open territory. That's when triple digits comes rather quickly. Hunt's $597 target comes from technical projections based on the full cup and handle pattern. When I say 3 digits, I don't just mean 100. That's a projection from the fixed price lows to the 80 high, he clarifies. This isn't speculation. It's mathematical inevitability based on technical patterns and supply-demand dynamics. This will be your first proper bull market since 1980. 2011 was a short quarter cycle that never got to play out. Hunt's analysis comes with sobering warnings. Explosive precious metals moves won't occur in stable environments. They'll accompany complete financial system reset with serious social consequences. It's going to be face-melting, but not good news in the world generally, Hunt warns. You need to think about your neighbors and how many people know you have precious metals. You got to worry about security. The economic environment involves cost of living issues and potential attack vectors if you're one of the gilded survivors. He believes governments will treat successful precious metals investors as enemies because they want people financially destroyed, ward of state, part of a UBI welfare system. Hunt's message for silver stackers. I think most of the bad era is behind you. We're in the contagion stage right now. However, unprecedented wealth creation through precious metals will occur alongside unprecedented social and economic upheaval.
Or do you have any other questions on that?
Well, I actually have a whole list of specific questions on how I thought the HVF worked, but we don't need to necessarily pound them all through to you now. We may have to come back and do a more detailed analysis of the model in the future. But let me ask this general question. I'm sure you're aware of the slingshot interpretation of silver and how it moves versus gold. There are certainly a lot of people who are in the camp that silver moves later than gold, but when it breaks out, it accelerates. And 39, I'm not sure where that shows up on all of your technical analysis, but just to a rookie looking at 39, it seems like a pretty big level. And so if we trade at 40, are you in the camp that silver's due for a real slingshot move?
Yes, I do. There's a couple of things you were asking. You were asking about the 39 level. And I think with that quarterly close discussion, that 37.65, 37.5 to 39 range, generally at the moment is being pushed back against somewhat. It's not being successfully rejected, actually. And I think some of the fundamentals could probably be leading into that. In terms of, you may also mentioned the HVF method, which is 3 impulses and a squeeze in volatility. We do still have a draw here that hasn't fully made its target, but did trigger. And that is the 3 impulses and the squeeze in volatility. So when you introduced, you missed the funneling word, which was Hunt volatility funnel. You actually get squeezed into, like a protein shake, almost into the funneling, and then you break. And we broke. We made our first interim target on a wick. We pulled back, which is typical target response. Then we made the second interim target over here, both done quite soon. And then you've been grinding higher. It's a little bit like a rising wedge. And we've got a lot of time to make this target. You'll see these vertical lines tell us our time stops. So you could still have a fall back down out of the rising wedge and that 2 shooting stars, a little bit of a pullback. I'm not even saying as far as 32. It doesn't have to be that far. It could be a bit further. You could pull back like that and then end up running the 41. The question is, will we ever get for this quarter a 41 close? And I'm not sure necessarily I can say that. Will that all happen in the next 6 weeks? Possible. So we could go down first, because I'm cautioning on the short term, you probably could get a better price. On the longer term, and it might not be that long, this could all happen in the next week or two with a bit of a yen carry trade like August last year, tail end of August last year, or the British debt situation. We get a little bit of, and then next thing you know, we are going back up. But you could also pull back a little harder and even revisit the funnel. I don't think so. That was a long way ago. That's extreme. But don't forget, we traded on spot, not that you could buy, $11 at COVID. It was either 11 or 14. We can check that now. You could forget about buying it at that price with premium. So let's just find 2020. What was the low there? Yeah, it was actually 11. But you could only buy, I think, for $14 something. And that was a great buy as well. So even if we get a drama of an event, that's a little spill that can happen. So it's possible. But for this pattern to win out, you can't run that stop. So I don't think the move's that big. You have a pullback, and then we go and we finish the 41 run, which will be a great close. And then it sets us up for, okay, can we go test 50? Probably get rejected because we've been rejected before, but that'll be the 3rd time, the 4th time we break. And once we through 50, that fourth time pass, which I still think we've got to go visit for a third time first, that is just open territory. That's when I think actually triple digits comes rather quickly then.
Okay.
And there is some real fanciful, I almost become a moon boy in terms of my bullishness, because that's open territory. And that again will be dollar debasement, but it'll also be the fundamentals of unobtainium, which we're already encountering in platinum, that we're not far off from having in silver.
By the way, unobtainium is a great word, especially if you have a South African accent, a little bit difficult for me. But so if we're going to reduce this, for those, again, following along, trying to pick out a few important numbers, is there a number or two you'd highlight? In other words, you just mentioned 40 is important, and then 50 means probably 100. What about on the downside? What are the negative numbers we should be looking for, or not looking for, but we should be aware of if they occur?
Well, that would come down to if we have an event similar to CV19. And that would be a very thin trade. And I would imagine a lot of banks would try to get out of shorts if they ever successfully got that same level of spill that we had there to happen now, to make that handle to the handle. I would imagine they would be very well served getting out of any derivative short positions as best they can there, because I think that's going to be a real problem. I mean, you think of solid state batteries that will be charging in a fraction of the time, running twice, 3 times longer. If they want all this battery technology, which I think they do, they want to track and trace us everywhere. They want us in battery cars. The more reason I'm going to buy diesel ones. But, that point aside, the performance of those were going to require just the 20% market take in normal batteries of solid state batteries would take 96% of mined annually supply. So, I mean, they really just don't have enough silver for all the technology uses that they have for it. So I would actually prefer to talk about the upsides once we pass 50. I don't think the downsides are exceptional. If you've been a patient stacker for a long time, and I imagine I'm talking to quite a few long-suffering patient stackers in the silver market, I think the most of the bad era is behind you. We're in the contagion stage right now in terms of where we are. If I just put a couple of lines up for you, this is the big numbers. These are the sexy numbers. You've got a 597 up there. So when I say 3 digits, I don't just mean the 100. That's a projection from the fixed price lows to the 80 high. And this will be your first proper bull market since 1980. 2011 was a quarter cycle, that never got to play out in full. And as I've said, it's almost the first leg of a 5-leg move. So that's a big number. We've also had 330. What we've done before is we've taken the inaccurate stats of the Bureau of Labor Statistics, CPI, AU, CSL, and we've divided it into silver just to show you how undervalued truly silver is. Let me just get the correct silver chart with a bit longer history. Forgive me for that. That pivoted to a broker I use. USD. We want a nice history, nice long history, and Rwanda, or should do. Let's do Rwanda, yeah. So that'll give you so what have we got here? This is, it's pivoted to gold. I want to just set it back to silver because that seems to be a particular interest. But it's very interesting on gold as well. This silver is yet to follow gold. I don't know if you got a little bit of a view of the gold, but this is yet to follow. So in terms of current pricing, we haven't even matched the 2011 high in the official, understating, in my opinion, inflation stats of the BLS. So just in terms of what inflation you have found, you are really buying right now discounted silver at $39, $38, $37, really discounted silver. This overall pattern, however, is, again, one of our volatility constriction funnels. And we actually say the third impulse, you should treat it as a breakout. So that is a breakout for silver for us. You have 3 distinct impulses in here. This is a very long-term chart. but that should be good news. You are already in a breakout, but it's truly still very cheap. And the running comes after that triggering event. Often in the beginning, you have a little bit of a go and a revisit. Then you get the melt up stage, and that's going to be face melting. But it's not going to be good news in the world generally. It's going to be good news for you. You really need to think about your neighbors and how many people know that you have precious metals. You've got to worry about security and all of that. I fear it's a reset, which comes with all sorts of social problems, cost of living issues, and potential attack vectors if you're one of the gilded survivors that actually did the right thing. The government is going to treat you as an enemy because they actually want you financially destroyed, ward of state, part of a UBI welfare system, which is part of a global Marxism that is being brought to bear on the Western world. So that's where I get pretty dark. Seize the opportunity. There are opportunities to build incredible wealth in these times, but recognize it's going to be a polarizing event, and the 95% are unfortunately on the wrong side, and they all become enemies and attack vectors and cuddle up to government and statism in their resentment towards you. So some of that CV19 didn't take the medical intervention type vibes can reoccur. Only now it's financial, and it'll be access to food, VIP access lines, empty shelves, price controls. There's a lot we can still do if we go down the full-blown Marxism, which I think this real-world asset tokenization, digitization, biometrics, surveillance state wants to bring in. And at a final little bit reset-y type vibe, Palantir, Blackstone, and BlackRock are not your friends, and you aren't doing enough to undermine them. Or do you have any other questions on that?
Well, I actually have a whole list of specific questions on how I thought the HVF worked, but we don't need to necessarily pound them all through to you now. We may have to come back and do a more detailed analysis of the model in the future. But let me ask this general question. I'm sure you're aware of the slingshot interpretation of silver and how it moves versus gold. There are certainly a lot of people who are in the camp that silver moves like.
Francis Hunt's analysis presents the most comprehensive case for explosive silver prices, combining technical breakout patterns with fundamental supply constraints and macroeconomic collapse scenarios, making traditional investments obsolete. His evidence spans multiple time frames: quarterly charts showing decades-long patterns, monthly analysis revealing systematic capping beginning to fail, and volatility studies indicating silver has triggered initial breakout phases while remaining at generational discounts. Hunt's $597 target isn't speculation. It's derived from technical projections of patterns building since 1980, combined with supply-demand fundamentals pointing towards silver becoming virtually unobtainable at current levels. For investors, Hunt's analysis suggests we're at the most critical precious metals inflection point in history. His identification of hyper-stagflation conditions, systematic data manipulation, and accelerating debt collapse creates perfect storm scenarios where traditional investments fail while precious metals become the only viable wealth preservation vehicles. The technical patterns Hunt documents suggest smart money has already positioned for precious metals. The question is whether retail investors will recognize the convergence of technical breakouts, supply shortages, and macroeconomic collapse before silver becomes unobtainium at any reasonable price. What do you think about Francis Hunt's silver analysis? Are we witnessing the setup for the most explosive precious metals rally in history? Share your thoughts below and subscribe for more exclusive market analysis revealing the forces driving the next major wealth transfer. Thank you.